Let's start together on slide 1. What is a reverse stock split? Clarity, strategy, calm thinking. Before we dive in, here's something to sit with. When a stock price suddenly jumps after falling for months, do you feel relief or suspicion? That tension is exactly what this deck is here to resolve. This session helps you stop reacting to surface moves and start reading what's actually happening underneath. The quote on this slide reminds us that markets vote emotionally in the short term, but they weigh reality over time. And right from the start, you're invited to grab the PDF handout. The link's in the description below, so you can follow along, revisit later, and reflect without pressure. Turning to slide 2, what we'll unpack. Notice how this agenda flows. First, what a reverse stock split really changes. Then, why companies use it. Then, most important, how you should interpret it. This order matters. Too many investors jump straight to, is this good or bad, without understanding mechanics first. If you've ever sold or bought based on a headline alone, this agenda is quietly calling you out, and fixing that starts with slowing down and following the sequence. Now slide 3, the core idea. The first point says fewer shares, higher price. That simply means the company compresses its share count. Nothing magical. The second point, market value stays the same, corrects a common mistake. If you thought value suddenly appeared or vanished here, that's the trap. So this boils down to one thing. Ownership doesn't change. One share at $10 isn't better than 10 shares at $1. If that still feels uncomfortable, ask yourself, are you anchoring to price instead of value? Moving to slide 4, why companies do this. The first bullet, meeting exchange rules, connects directly to survival. Major exchanges don't allow ultra-low prices for long. Next, avoiding penny stock stigma. This is perception management, not deception. Institutions often won't touch stocks below certain prices. And that leads into the third point, attracting institutional investors. Here's the reflection. Are you judging management for trying to stay listed, or are you asking why they're in that position in the first place? On slide 5, signal reality. This slide exists because most people stop thinking right here. A reverse split feels negative, so investors panic. But the second bullet reminds us, sometimes it's part of recovery. The quote from The Intelligent Investor fits perfectly. Value isn't what flashes on the screen, it's what survives scrutiny. Ask yourself, when was the last time you mistook a signal for the full story? Now slide 6, what shareholders experience. First, same economic value. That's the anchor. Then comes short-term volatility. This is where emotion shows up. The third bullet is the quiet warning. Emotional reactions drive price moves. If you've ever sold just to stop the discomfort, this slide is pointing at that habit. How could you pause longer next time? Turning to slide 7, potential upsides. Regaining compliance is not glamorous, but it's necessary. Improving perceived legitimacy builds on slide 5's idea of signal versus reality. Reduced volatility is conditional, not guaranteed. This slide isn't promising upside. It's reminding you that structure can stabilize if fundamentals follow. Are you checking fundamentals or hoping structure does the work? Now slide 8, real trade-offs. This is the balancing slide. First, yes, it can signal distress. Second, no, it doesn't fix weak businesses. The quote referencing the psychology of money nudges you to notice your own behavior. Are you avoiding a stock because it feels embarrassing to own, or holding one because selling feels like admitting a mistake? On slide 9, history teaches patience. Citigroup, GE, different outcomes, same tool. That's the lesson. History doesn't tell you what will happen, it teaches you what to examine. If you're ignoring business health and copying outcomes, you're skipping the hardest part. Now slide 10, tax implications. This slide exists to prevent future headaches. Most reverse splits aren't taxable, but fractional share cash-outs can be. If you've ever been surprised by a tax bill, this is your reminder. Details matter. Are you tracking cost basis carefully or assuming your broker handles everything? Moving to slide 11, when it might be worth watching. Strong balance sheet, clear turnaround plan, improving fundamentals. These aren't exciting, but they're decisive. This slide quietly asks, do you chase excitement or do you wait for evidence? Bogle's philosophy fits here, discipline over drama. On slide 12, try this. Ignore price alone. That directly fixes the mistake from slide 3. Read the filing, not the headline. That corrects slide 5's signal trap. Waiting for sentiment to settle is patience in practice, and deciding with rules, not emotion, that's how you stop repeating the same investing errors. Now slide 13, a question worth sitting with. What other negative signals might deserve a second look? If you're honest, you've probably written something off too quickly before. This slide isn't asking for action, it's asking for awareness. Finally, slide 14, the calm investor's lens. Structure changes. Value doesn't. Markets react. Investors assess. Understanding beats guessing. This closes the loop back to the title slide. Calm isn't passive, it's informed. Grab the PDF handout link below, revisit the slides, and reflect at your own pace. If this helps slow your thinking and sharpen your judgment, consider subscribing to the channel. These videos are built to help you think better, not faster, and that edge compounds.